$7 million job openings, a Fed on pause, and mortgage rates pushing back towards last fall's highs. We have got a full plate. Welcome back to RealPage Economy Express. The Fed held steady, keeping the funds rate at about 3.75%. The statement struck a familiar tone. Solid growth, but inflation still somewhat elevated. One member wanted a cut, the rest said not yet. They're watching and waiting, and frankly, so are we. The inflation picture explains why. February PPI came in hot, up 70 basis points on the month, more than double what Wall Street had penciled in. Year over year, producer prices are running 3.4%, the hottest read in a year. Both services and goods pushed higher, and core PPI has now climbed for 10 consecutive months. Consumers are feeling it too. The latest PCE price index came in at 2.8% year over year, with core at 3.1%. Income grew a little, but real spending barely moved. The savings rate drifted down to 4.5%. People are still opening their wallets, but they're not getting much more for the money. The labor market keeps telling the same story, steady but stuck. Latest weekly claims landed at 210,000, right in the neighborhood we have been in and quite below expectations. Continuing claims actually fell to their lowest point since mid-2024, so layoffs are not the issue. The latest JOLTS data showed opening ticked up from the prior month, but still running well below year-ago levels. Hires flat, quits flat, nobody is getting fired, and nobody is quitting. So it's a standoff. Housing is where the tension really lives. New home sales took a hit in January, dropping nearly 18% from December to a 587,000 pace. Supply stretched to almost 10 months. Construction spending pulled back too. The highway and public infrastructure work kept things from looking worse. Pending home sales gave us something to work with, up nearly 2% in February, with the Midwest leading the way. But mortgage rates are fighting that momentum. The 30-year fixed jumped to 6.4% last week, the highest since October, and applications fell more than 10%. Refis got hit hard, and purchase activity softened. Oil prices are keeping a floor under Treasury yields, and that pressure is landing right on the doorstep of every borrower. And to close it out, the Conference Board's leading economic index slipped again, but dig into the details, and 7 of 10 components actually improved over the past 6 months. The board is calling for 2% GDP growth this year. The headline reads cautiously, but the underlying index looks more stable than that. Rates parked, inflation stubborn, jobs steady, housing caught in the middle. The economy is holding together, just not going anywhere fast. Thanks for watching RealPage Economy Express.